Hi, my name is Karen and I'm from Keller Williams Executive.
And I'm Benson Pang with NestMade Mortgage.
And today we're going to talk about loan contingencies in a real estate transaction. Now in California, there are a lot of people who ask us all the time, what are contingencies and how do they help us with the buyers in this real estate market? So today who I have here is I have Benson Pang from NestMade Mortgage, who is going to dive a little deeper in what it means when it comes to appraisal contingencies and loan contingencies. So the big question is, what is a contingency? And a contingency in real estate is a condition that must be fulfilled before a sale of a home can close. And in California, we use the California Association Realtors Purchase Agreement document. And in there are three major categories. There is the appraisal, the home inspection, and the mortgage approval contingency. So with that, today we're going to have Benson here go over what it means to remove an appraisal contingency, really, because that is something that we're finding very common in today's market. Benson, what we're seeing in the market is a lot of sellers are asking buyers to remove the appraisal contingency.
Yeah.
So can we dumb it down a little bit for those who are out there that what it really means in layman's terms?
Yeah, and to piggyback on what Karen was saying is, if you're buying a house all cash, man, appraisal, loan, nothing to do with you, right? But if you're getting a loan, just like 90% of the individuals out there buying a house, not all cash, most likely you're going to need a loan. And when you're getting a loan, you need the bank to approve you, right? And the bank wants to know what the value is. You're buying the house next to your mom's house, let's say across the street. To you, it means a lot. I'm gonna buy it 20-30% over the market price, but doesn't mean the bank's going to loan you that money based on that purchase price. In fact, they're going to loan you the money based on the market price, which is what's going to happen when you order an appraisal. The appraiser going out there to make sure the value of the house is worth the amount that you're buying. With that said, appraisal contingency, what it is it is a safety net that helps buyers buy the house. Let's say you're buying it 20% over asking price, and you order appraisal, it comes back maybe short. Now you can actually back out of escrow, back out of the contract, and you don't have to pay any damages, or you don't need to explain to the seller really why you're getting out of escrow. But it is a big thing because the seller, when they go into escrow, they really want to sell. They might have places they need to go, they need to relocate, they want to sell this house, take the money and put it on the new house. Am I right?
Yeah, so Benson, as I was saying earlier, in today's hot market where it's really a seller's market, a lot of the sellers, I would probably say 99.9% of the sellers out there are asking buyers during the counteroffer process to remove the appraisal contingency, right? Mm-hmm. So what kind of risks and what does it mean for the buyer? So when you're going through removing your appraisal contingency, a couple of things you want to talk to your loan officer about, right? Do you yourself have enough money to cover the difference? Like, let's say, for instance, if you're buying a house that's $1 million, you're putting 20% down, and you're getting a loan for $800,000. Let's say it comes back at $950,000. Now you're short $50,000. Does it mean you have to put $50,000 to cover the difference? No. Not necessary. What the bank look at is loan to value ratio, right? LTV, loan to value ratio, meaning $800,000 divided by $1 million purchase price. That's 80% LTV. 20% down, 80% LTV. Now that your appraisal comes back at 950, your LTV is now at 84%. And a lot of banks at 84%, they want to see that mortgage insurance. So talk to your lender and say, hey, what is the maximum LTV that is needed for this loan? And a lot of times it could be 95% LTV. That means that the house can actually be appraised much lower than what you're needed, and you can actually still buy the house
there is mortgage insurance. Your payment will go up a little bit, but you can still buy the house. A couple years later, you can refinance. And on the other side, if you, let's say you don't want to pay mortgage insurance, you can actually pay the difference and keep an 80% loan to value ratio. In this case, $950,000. If you want to pay it down to 80% loan to value, that's paying down to $760,000 in loan.
So what does a payment actually look like if we're looking at what you just said with the scenario that you had just provided us?
Yeah, so let's say you're at 84% loan to value. You have to pay mortgage insurance. A lot of people think that mortgage insurance is this very, very expensive thing, but in reality, it's at 84, you're looking at maybe about $100 per month if you have really, really good credit score. And talk to your loan officer and explore that option so you can really, really know what that number is before you get into escrow, before you even put in that offer pre-game, so you know what the outcomes could be.
Awesome. Thank you for that. So if you guys have any more questions about the appraisal contingency, feel free to give myself or Benson a call, and we'll be more than happy to help.
Thank you.